Good afternoon, everyone, and welcome to the 7th webinar of our 2014 series, Insurance by the Numbers, where we're focusing on a different number each month from 0 to 10 and how those numbers impact your clients in the insurance world. This month, we'll share with you the top 6 reasons people want permanent life insurance in place when they die. Our presentation today will last between 50 and 60 minutes, and you must be logged on for at least 50 minutes from the email address you registered with to qualify for CFP credits. If you have questions as we go along today, feel free to ask them on screen, and we'll do our best to answer them timely and anonymously. And our webinar is being recorded, and it'll be posted to our website within about a week. Your presenter today is Keith Maurer, or as he's known around here at LLIS, Keith the Omnipotent Insurance Guru. He's been in this industry for 40-plus years as a product researcher and developer, an actuary, and product distribution strategy consultant. He's an expert at the complex cases we handle for many of your clients. And now, to learn about this month's number 6, I give you a man who loves the number 6 because it's how many Guinness bottles come in a pack. Keith Maurer.
Thank you, Dina. I hope everybody can hear me all right. I've got this thing settled because there's no way for me to know if they're hearing me. So today we're going to talk about permanent life insurance. And I want to sort of define that just for a second. We're going to stress more in later in life needs for life insurance. But actually any insurance that is enforced when you die, I guess it could be considered a permanent policy. So. But we're going to focus on things later in life, and number 2 are things that normally don't have an ending. For example, things like, if you buy mortgage insurance for your house, in theory, there will be a time when the mortgage is over. You know it's a 20-year mortgage or a 30-year mortgage or whatever, so there's an end to that. Maybe funding college tuition for your newly born child. You know that in 20 years or 22 years or something like that, that need should be gone away. So those are not things we're going to talk about. We're talking about things a little bit more permanent and later in life. Okay, Dina, I need help here. There we go. So permanent life insurance. We're going to talk about 6 things right now, probably the 6 most common use of life insurance. And one is final expenses. People do die. That's sort of a given, and there are expenses at that period of time. We're going to talk about replenishing the nest egg. That's referring to the investments or money that you've put aside, your clients have put aside up to retirement, and then living off of that, and then maybe replenishing it at the first death. We'll talk a little bit about estate planning. And this is, as you know, is not estate tax planning, it's estate planning, and we'll talk about my definition of what estate planning is. We'll talk about special needs children, parents who have a special needs child. We'll talk briefly about pension max. I'm only mentioning that because that is a frequent use of permanent insurance, but we've had a whole webinar on that, so I will spend very little time on that. And finally, we'll talk about the sort of the newer combination of benefits, which life insurance being one of them, and another benefit besides that. So that's the 6 subjects we're going to talk about. Now, I mentioned 6, but there was an article just last month written by the CEO, president of Life Happens, and the title of his article was 20 Reasons that you may need life insurance after age 60. A lot of them are included in the 6 here. Some of them are combinations, but a few that I'm not mentioning that he did was to pay off debts. He has actually 4 reasons that include small businesses, why a small business may want insurance after the person is age 60. And in a couple months, I'm actually going to come back and talk about small business insurance, so I've eliminated those. He talks about gifts to charity, charitable giving with the use of life insurance, and then we're also he also talks about the life insurance is creditor-proof in most states, not all states. And then finally, he has one which I sort of like his philosophy. It says and I quote here, it allows parents to spend all their money and still leave a legacy to their children or grandchildren. And he does that with life insurance. So I guess the good news is this is only an hour webinar, and I only can do 6 because if we were doing that one, you'd have all the way up to 20, and we would not get it all done. So anyway, so there's more than 6, but I'm only going to talk about 6. So permanent life insurance. Let's review. If permanent life insurance means that the policy is in force until you die, that begs the question, so when are you going to die? And actually, actuaries have come up with the answer to that. It's called life expectancy. In my opinion, this is probably one of the most misunderstood statistics in the insurance world of life expectancy. Life expectancy is when you start out with a person of a given age, we'll say age 55. When will all males age 55 alive today, when will 50% of them be dead and 50% of them still be alive? That's the definition of life expectancy. It's when it's just a little bit, one death over the average. Now, averages I think are also interesting because, you know, people never have average children. And being a grandparent, I will tell you that no one ever has average grandchildren. They're all above average. So why do we think that the only time somebody's going to be average is when they die? That's just a thought maybe. There's no answer to that one, just thought. So let's look at an example here of a male, age 55, and currently healthy today. Obviously at age 55, we're all alive, so none of them are dead. If we go to age 75, 17% of those who were alive at 20 years ago will have died. At age 81, 37% of the people will have died. If you look at the bottom of the page, life expectancy is 84 and at age 84 and 8 months. That's when the tipping of the 50% will have ended. You go out to age 86, and now 57% of the people have died of the males that were 55 back here. And if you're going to go by the 80% rule, which I know some of you do in some of your planning ideas, that you can never cover all the time 100% of everything, but you try to prepare for the 80% rule. When will 80% of the 55-year-olds that were alive that day, when will 80% of them have finally died? Well, that's age 91. So life expectancy is the average. When 50% of the people who are 55, the males age 55 have died, that's going to be age 84 and 8 months. But if you really say, you know, I'm above average, whatever that means, and you want to get more toward the 80% rule, for males age 55, you get to go all the way out to 91. So life expectancy is, you know, what you want it to be. By the way, if you want to be able to do this for your client, we have on Agents Advisors Tools on our website the ability for you to do this. You simply pull it up. You put if it's a male or female, you put their current age, and then it'll immediately tell you what life expectancy is, which is the 50% rule. But then you can put in any number of percent you want. You can say, when will 75% of them be dead? When will 80% of them be dead? When will 90% of them be dead? And then we'll recalculate that life. So this screen that you have on here doesn't look like it's going to give you a number. But if you want to be able to do this yourself, you can with the tools on our website. For females, by the way, age 55 today, for their 80% rule, or when will 20% still be alive, it goes all the way to 93. So for the women out there, you will probably live longer than your male who's the same age, but the gap between the male and female life expectancy in the United States is narrowing. It's becoming less and less, and there's all kinds of reasons for that, which I won't go into, but females still do live a little bit longer than males, but it's not as much as it used to be. So what are permanent policies? Now, permanent policies, like I said, if it's enforced when you die, it was permanent for you. But there's forms of permanent policies, all of which sort of apply to what I'm going to be talking about. So probably the more traditional I shouldn't say traditional, at least been with us longer than most forms of permanent insurance, is what's called the whole life policy. Technically, a whole life policy has fixed premiums, has a fixed death benefit. It must endow, which means that the cash value will equal the death benefit at maturity. And many of them do pay dividends, which are technically unused premium, which is different than a dividend you would get from an investment. And many times those dividends can be used or are used to pay the premiums that are due, because the premiums are due for the whole life. But if they're not paid by cash out of the pocket, they may be able to be paid by dividends. So that's whole life. Then came along universal life. Well, universal life is a flexible premium and is a flexible death benefit, and it earns a declared interest rate. And it, by the way, will have a guaranteed minimum interest rate that will always be a positive number. It may be 2%, 3%, 4%. It'll be a relatively low interest rate, but it's always positive, and it will always earn some positive rate of return. And this policy stays in force as long as there is at least $1 of cash value in the policy. It does not need to endow. Matter of fact, probably most of them won't or don't. They can over-endow. It's just how the cash value goes. So different than the whole life, but in many senses still sort of similar. We then have the more recent version of that, which is a guaranteed universal life, sometimes called the GUL. It also has flexible premiums. It also has a flexible death benefit. But this policy stays in force based on the premiums paid, not on the earnings of the contract. As a matter of fact, many times with these policies, if the premiums are paid in certain ways, there will be no cash value, but still many years of extended guaranteed death benefit. Some people call them term for life. They can be that, but they can have cash value. So, but it's not determined about the earnings of the contract or if there's dividends or not. It just depends upon how much premium you pay and when you pay it. Let's see, when does there's a question here, but I'm going to get to some of those here in a little bit. Then there's variable universal life. Variable universal life is similar to universal life, with the exception of, rather than having the cash values earn a declared interest rate, you, the advisor, or the client actually gets to choose which investments that are, now you don't get to choose all investments. Each policy will have their set of funds, and then you can choose how you want your cash values put in which funds, and then the earnings will be dependent upon how those funds perform. There is no minimum interest rate guarantee. It has, matter of fact, it can be negative. So it has a potential of a much better earnings and also has the potential of going backwards. And it is like the universal life. As long as there is at least $1 of cash value in the policy will stay in force. Then, so all of these are permanent policies, but then just to make it a little bit more interesting, all of these have both an individual version as well as a survivorship version. And by the way, I've got a couple questions that I'll try to get to. If I don't get to your questions, you have my promise that I will personally email to you within probably the next day or two full answers to any of your questions you ask. So if I don't get to them, it's not that I'm going to ignore them. I will email to you the full answer to your questions. So why do I need life insurance past age 65? You know, aren't there alternatives? So, you know, won't the government take care of my spouse? Won't our kids take care of our spouse, or take care of my spouse? Or I have so many assets, I don't want life insurance. All those are possible. Those are answers. But he has another question. He says, so why do all the rich people, and I consider people who have $15 million or more of investable funds as rich people, why do 91% of those actually own permanent life insurance? As a matter of fact, why do the average of them, why do they own an average of 5 policies? Well, you've seen this chart before from me, and the point is sort of that they're either using it to conserve their wealth, to replenish their wealth, or to expand their wealth. And so you can read, read the answers, but the point here is that they have figured that for a small amount of money, you may have a large amount of death benefit. That the reasons that they buy it is to, like, it's replenish their wealth, create liquidity. All those are needed. They're needed for people who aren't millionaires as well. But these are the reasons why people who have a lot of assets still choose to add life insurance as one of their assets. And the equalize the estate, I'm going to talk about that later when we talk about estate planning. So that's a point that's maybe not obvious, and I'll explain it a little bit later. So, but there's actually one more reason why more and more older people are actually buying permanent insurance, and that is because in 1995, 14% said that they planned to work past age 65. In 95, things were good. People were adding to their retirement plan. They thought that by then they would have enough money built up that they can live the rest of their life without it. They don't need life insurance. But now, in 2010, which is the most current survey, 31% say that they're planning to work past 70 and or never retire. So an additional reason why people are buying longer insurance or permanent insurance is actual the income replacement, which we have always historically thought was only a term need. So that's sort of some of the reasons why people buy, but what motivates people to keep or buy or to keep insurance past age 65? Well, part of it is logic. Many of them have owned it all their lives. They either have had group insurance through their employer, they've owned a term policy, they may have owned a small whole life policy or a large whole life policy, but they don't want to give it up now that they realize they're going to die. I hate to say it, but I don't think most 35 or 40-year-olds realize they're going to die. They know they're going to die, but they don't really actually visualize that things going to happen to them. It just happens someplace so far down the line that it just isn't something you think about. When you get to 65, you start having situations where you realize that it may happen to you, and so that's probably the time you want life insurance, is when you know you're going to die. There's the emotional part of it, which is very close to the logical part, is they've been touched personally by someone who has died, either in their family or a good friend, and it happens more and more as you get older. I'll tell you that for a fact. And you will know from how close a friend you are, eventually you will know, was the ducks in order, was there life insurance, was there plenty of other assets, that kind of stuff. And they can see what happens to people when there's not enough assets left at the death of the spouse or something like that. So they get involved emotionally with these kind of decisions. And the other reason why is because the reason you bought insurance for the first time, the first or second or third time, it just keeps changing. You probably bought the first time when you got married or you have a partner and you want to take care of each other, so you buy it for a spouse. And then, lo and behold, there's children. And so I better keep it now because now I've got children. Then the children go away, but maybe you're responsible for your own parents. And then the parents pass away, and then your children come back. And then all of a sudden you say, well, maybe I want to take care of my grandchildren. So point being that a need or a want for life insurance doesn't stop just because you reach age 65. Other things keep going and keep changing as time goes on. So let's start zeroing in on the needs for permanent life insurance. Final expenses. Number one. First of all, why life insurance? Well, it's income tax-free. You put in an amount of premium. Pick a number. We've put in $30,000 of premium, and we get $150,000 death benefit. All that growth, all the difference between that is never taxed. So, and the total amount is income tax-free. It is cash, and it's cash when the survivors need it most. And why do they need it? Well, there's always going to be some sort of funeral expenses, and most of the time there are medical expenses. And this is a question I've asked many times, and I didn't realize what this all entailed until I was actually it for my parents, and it's more work than you want to think it is, and I can't imagine it being. Both of my parents had very little when they died, and it was not a big deal from that point of view. But there's so many details and things to do. But you have probate concerns. You have liquidity choices. You have timing of liquidity. What do you sell? One of the things, a very successful financial planner, Kathleen Reel, who, by the way, is going to be speaking at our National Academy this coming fall, or coming winter, coming February. That's winter, every place except Florida. And she says, don't make decisions of selling things, moving out of the house, doing anything like that for at least 6 months to a year. And if there is no cash, if there is no life insurance, if there's not a lot of things that are extremely liquid, like checking accounts that you can get to without having to go through probate, then it's but if you have to start selling mutual funds and all that kind of stuff, you sort of have a problem. So life insurance is there when you need it. It's cash when needed most. 80% of the people, and I believe this is, I don't have it all the way completely out, it's 80% of the people over age 65 in the United States. 80% of the people over age 65 in the United States have a long progressive illness such as cancer, heart failure, or Alzheimer's disease. And why is that significant? Because that's when and where you spend your money and how you drain the nest egg. This can just suck out all the assets that you think you're ever going to need in one. It's not impossible to run up a medical bill of $1 million or more. And so what does life insurance do? Well, it removes the legal hurdles. You don't have to worry about ownership or go through probate. It passes on by contract. The market problems, the Peter principle that says anything that can go wrong will go wrong. Well, the time you need to sell something at the marketplace that may be the lowest time to try to sell something, so you don't want to do it at that time. The corollary to Peter's principle is, by the way, that Peter was an optimist. The optional emotional stress that you have to do to have the survivors to make decisions, all those go away with life insurance. I have a question that says, with a step up in basis upon death, does this make it easier to sell any investment within a taxable brokerage account? That is true as a step up on cost basis that way. If it's qualified money and or in an annuity, that would not be true. So yes, the step up in cost basis would avoid the taxation of selling something. That's correct. But life insurance, the specified amount, you know exactly what it's going to be. You may think you know that you have X amount of money in stocks or bonds, but you don't know if it's that amount if you sell it that day necessarily. It is 100% liquid because it comes in cash. It's the real value. It's immediate access, decision-free. You don't have to decide what to sell, and it's the ability to equalize the estate. How do you split a house? Again, I'll talk about equalization of estates with estate planning. So here's a real-life case. This is Verena's plan. Verena is a grandmother who moved from Nebraska to retire in Florida. Her final expenses, we need to round it obviously, $14,000 for funeral expenses. She died in Florida and had to be taken back, her body. She was not cremated. Needed to get back to Nebraska, and that is very expensive, by the way, in case anybody has to do that. It's not an easy task to do, nor is it cheap. She actually had very little, comparatively, final medical expenses, $17,500, and in her will, she had made it be known to all her children that she would like her children and the children's spouses and grandchildren to be at the funeral in Nebraska, So she would pay for the plane tickets, and the plane tickets ended up being $6,875. So basically, there was a cash need very quickly of $38,375. Not a big deal, most people would say, but let's talk about what Verena had as her major assets. She still had the farm. She still had a 160-acre farm in Nebraska, which is rented by her son, and her son pays rent annually. She also had Social Security, and she had about $25,000 in checking account, fund, cash, mutual funds, things you could sell, that kind of stuff. So here's the dilemma. There's, you're the executor. You need to come up with $38,000 of cash relatively quickly, and you have approximately $25,000 to do that. There's plenty of assets. Absolutely, there's plenty of assets. A 160-acre farm in Nebraska, I don't know, probably $500,000, something like that. It's valuable, but are you going to sell it? Are you the executor? Are you going to sell it? And how soon could you sell it? So, luckily, Verena had one more asset. She had a $75,000 paid-up policy. So, not only did you not have to worry about selling the mutual funds, there was enough cash to pay for that and for other things, as far as, so there was some cash to go on besides having to split the farm. So, so Verena's plan, and the point here is, people like this live everywhere, every day, all the time. It doesn't have to be a $1 million policy to be significant for someone's life to be simpler. In essence, I guess Verena was half a millionaire at least with the farm she owns, but it's not an asset that you can do. And if you're the executor, you have a dilemma that you have immediate cash needs and not immediate cash without the life insurance. It says, how long does it take to get the insurance out of an insurance company to pay? Most of the time, it's relatively quick, usually about 30 to 35 days. If you have things in what the insurance companies are going to need, they're going to need a certified death certificate. They're going to need original certified death certificates, not a photograph. So if you're an executor and you're around at the time of death when there's going to be death certificates done, for number one is ask for like 4, 5, 6 copies right then. So they're going to need a copy of the death certificate, and if there's a policy, they want the policy. If not, there has to be a loss policy affidavit. So there's a little bit of paperwork involved. If you notify the insurance company or notify us if it comes through us or the agent, they'll usually get a packet out in relatively short order, less than a week. And if you have all the papers you need to send back to them, usually you will get it within a month, within 30 days. And by the way, from the date of death till the date that they pay, by law, they must pay you interest. So that if, we'll say, this $75,000 policy of Verena, if she died January 1st and they didn't pay till February 1st, there would be 30 days of interest at whatever the guaranteed interest rate of the policy was, and it was probably an older policy that maybe had 2 or 3% interest, must be paid. So while yes, it is not immediate, meaning it's not that very next day. Most bills aren't due within 30 days, or a lot of medical bills and that kind of stuff can be put off for a little bit longer. Working with funeral homes, which I have, if there's an insurance policy, they'll take some down and get the rest of it when the insurance policy pays. But it does take a little time, but the number one thing is if you're in the situation where you can make this happen, when they do the death certificates, make sure you get a couple extra copies. So, the second reason, replenishing the nest egg. What does that mean? Well, as we talked about, that 80% of the people over age 65 have a prolonged medical situation. And the majority of your medical expenses, and including all the insurance premiums you've paid for all your life, on all the other doctor's appointments and medicines or whatever, that over 50% of all that you pay during your lifetime will be paid during the last 24 months of your life. It is a huge reason. It is the #1 reason the causes of bankruptcy in the United States is medical bills. And then the same thing of the unexpected market dive is when the nest egg gets depleted because of all these medical bills. You're starting to pay stuff on. It doesn't always happen, but it seems like that's when you could have unexpected dives in the marketplace, which depleted even more. And worse, because we're now older, is you have less time for that to build back up. It's because many times what you need is time, and you don't want to spend the money, but you have to. These are statistics also, 48 million people retired in the United States, 78 million more in the next 17 years. But you may not know this, that 40% of them, according to LIMRA, they say that they plan on using life insurance to transfer their wealth. That's a lot of people. 40% of the 48 plus 78 million, and 40% of them plan on using life insurance to transfer their wealth. That's a lot of people, and that would be long-time permanent insurance needs. The replenish the nest egg concept is really simple. As two of you are alive, most of the time 2 people are alive, they spend down their nest egg, and then when one of them dies, they replenish the nest egg for the other person to live on. And it'll be depleted when they have long-term illnesses and spending for medical expenses and final expenses. So, simple concept, but does it work? Why life insurance? And I say it's somewhat of a simple math. The rate of return on premiums and death is a pretty good rate of return. There are obviously other alternatives, and I choose to say that I believe this one is one that it works. It also is guaranteed. It's also income tax-free, and it may be estate tax-free. But what do I mean by good rate of return on premium? This happened. I use it as a single premium because it's easier to envision, I think, and calculate. But it's calculated on any way you pay for the insurance. But I just took a male age 60 single premium and gets a death benefit. What rate of return would you have to have on that investment every year compounded in order to end up at these various ages to have the same amount of death benefit, same amount of money as you would with a death benefit? Well, for a 60-year-old, his life expectancy is 86. So let's zero in on age 86. At age 86, he would have had to have on a after-tax basis earn 6.1% every year compounded for 26 years. And if it's a taxable, and we're assuming 20% tax bracket, and I realize there are other things involved, but it would be approximately an 8.4% rate of return. But even if he waits till 95, and we know by then more than 80% of them more than 80% of the 60-year-olds will have died. A 6.2 taxable or 4.5% net after tax compounded from day one is what he would have had to earn to get it. So from a replenishing point of view, rather than having all-in investments and with the idea of taking some of the money and putting it in life insurance to replenish the nest egg, the rate of return you get is really fairly good. And if he happens to die early, it's phenomenal. And even if it dies late for the replenishing of the nest egg concept, may not need it at all. The other person may have already died. So, but even at age 100, you almost have a 4% rate of return compounded and guaranteed net after tax. So fairly good rate of return. So now that we've talked about final expenses and replenishing the nest egg to live off of, let's talk about estate planning. And my definition of estate planning is how assets are distributed at death. It's not tax planning, and everybody should or has to do this. What's going to happen to what you own at your death? And so, there are many challenges, even when it's not a tax issue. Many assets are not easily divisible. And what I mean by that, this is where I talk about estate equalization. If a farm is a good example for Verena. That, in theory, can be divided relatively equally. You know, you get an 80 acres, you get 80 acres, or you get 20 acres and you get 20 acres, or whatever. Usually, you don't do that. It's not something that if you have 20 acres of land, you probably can't farm it and make a living off of it. You need the 180, 160 acres or more. I mean, now they're talking hundreds of acres, thousands of acres. But point being is that that's a good example of an asset that's not easily divisible. Why would you want to divide it? Well, if you got 2 or 3 children, as Verena did, and the farm, and they want to keep it intact so that the one son can continue to farm it, it's not necessarily the easiest thing to divide. And sometimes you want a specific asset to go to the specific beneficiary. Homes are usually a good example that we see in wills a lot of times when one child may live in the same town, may or may not be taken care of the parent. There's all kinds of reasons, but for some reason you want this one specific child to get the house. And so what do you have to equalize that so that the other child gets something too without getting part of the house? And so, and then the third reason why it can be a challenge in passing on assets is second marriages, especially when there's with children, his, hers, ours, what was theirs, what's a new spouse get. So there's many challenges. And again, life insurance, it's cash. It can be used to equalize it. You can by contract direct it to who gets what amount of it, that kind of stuff. So it's an easy tool to work with in estate planning. But to pass on assets in death has the continuous battle. Should I use life insurance or should I use investments? And there's never a 100% answer to that. There's always exceptions. But I'd like to put the case up for life insurance if the goal is to pass on assets at death. Now, this looks very similar to the previous one, except now we're using a second-to-die contract. And the reason I'm using a second-to-die contract is because many times you want to pass on assets after the second death of spouses. And the rate of return, internal rate of return on a survivorship is better than on an individual policy, mainly because there's rarely from an insurance company point of view, rarely an early death benefit needs to be paid. One of them will live longer than the other, and so one may die of an accident. Obviously, 2 can die of an accident, but one may die of an accident, and the other will live longer, more of a natural life expectancy. So from the insurance company's view, they can offer a better deal, so to speak, is how much life insurance you can buy for the same amount of money if you have two people on it. And here's a $100,000 single premium for a 65 male, female. It can buy $562,000 of death benefit. And then, what's the rate of return? Well, at age 95, if both of them live 30 years, the pre-tax is 8.2%, and the after-tax is 5.9%. Even if they both live to 100, the second one lives to 100, you're talking about a 5% rate of return. So passing on assets, there's a reason 40% of America thinks they're going to do it that way. They can pass on the money, and they can do it on a guaranteed basis, and it ends up being a good way of doing it, in my opinion. Here's the greens. The greens is an interesting case. I could talk about this one case literally for the whole hour because there's so many details involved. But this is Andrew. Andrew is the grandfather, great-grandfather of some of these. The father, grandfather. His wife has passed away after having a long illness that required nursing care for many years. And this is Barbara, his daughter. He has a daughter and a son. Barbara has 2 children, and there's no father in sight that has anything to do with anybody. And Andrew has been financially taking care of Barbara and her 2 daughters for years and years and years, and that still bothers him. what is his concerns? He's worried about himself, about the future of medical care and nursing home costs. He sees it going up and going up, and he is not looking to have the cheapest place in town. He didn't do that for his wife, and he did not plan to do it for himself. He wants to provide college education for the great-grandchildren. The grandchildren are pretty much already taken care of or close to it. He plans on providing forever some income for his daughter Barbara. His son, by the way, has a company, a small business that is very successful, and his grandson, which is his son's son, is in the business too, so they're financially pretty well set. He does have an estate tax problem. Most of his estate is in a deferred comp and in qualified plans, so he knows there's going to be estate taxes due because his total gross net worth is well over $12 million. So, so what did he do? He bought a guaranteed contract, guaranteed UL, and put it into an ILIT, gets it out of the estate. He plans on the death benefit being used in part to replace all the assets that he is going to spend in the nursing home, that he thinks he's going to spend in the nursing home. He's going to spend it down and then replenish the nest egg, so to speak. Pay him for estate taxes because he knows there will be some. He wants to set up so that there's plenty of money for Barbara for the rest of her life, and he's going to set up a trust for the great-grandchildren's college education. So this is one of our planners on the West Coast that did this. This is not their pictures, by the way. It's their names, their first names, not their last names. But this is a real family and a real situation, and pretty much as I defined it. But it got very interesting and very, I shouldn't say complicated, but it was very interesting in what people's concerns were. And you could say, the guy's worth $12 million, for heaven's sakes. What's he worried about the nursing home care? He was, you know, and he didn't want to spend his kids' grandchildren's or great-grandchildren's money for that, and so it was just an interesting case. What's going on? The special needs children. Planning for special needs is, for those of you who have done it, thank you so much. It's a heartwarming and heart-tearing at the same time. Many of the children with special needs actually have normal life expectancies. There's a statistic that says there's 730,000 people in the United States under the age of 21 with autism, and people with autism have normal life expectancies. There are people with Down syndrome. Their life expectancy is age 56, so it's not an early killer necessarily. And many of these people, if not most of all, will require some lifetime financial assistance, and the greatest exposure is when both parents are gone. And so do they have alternatives? Sure they do. There's always the siblings, there's always the brothers and sisters, that when the parents are no longer around or be able to do it, that the brother or sister has to step up. The state, the state can and will step up and do something. If you do any of this, I just want to say that you do need to consult an attorney who specializes in special needs trusts, and I'm not one, so I'm just giving you advice to do that. And I'm saying, considering a survivorship or second eye policy to fund this, and by the way, the parents no longer need, well, never needed to be married, but many times people think you can't get a survivorship if you're not husband and wife, if you're divorced or whatever. Sure you can. You do not need to be married to get a second eye policy. This is, again, another true, same case, real case. This is Dave and Susie. Dave is 44. He was standard. They bought a $2 million 20-year term policy on himself. Susie is preferred. She's 42. And they bought a $1 million 20-year term on her. And they have Stephen, the special needs son, who's age 8. She had him at age 34. He's age 8 right now. And they're pretty well feel that they can as long as one of them is alive, to make sure that everything's taken care of, and they've got term insurance for income replacement and to fund that as long as one of them's alive and that kind of stuff. But they worry about what happens when both of them passed away. So the son, which is not Susie, it's Stephen. Stephen will require lifetime assistance. He does not have a life-threatening problem. And so the advisor recommended a $2.5 million guaranteed survivorship contract. The annual premium was $10,295, and it was guaranteed for life. Just as a side note, there are different types of guaranteed contracts. Most of them do not have much cash value, thus keeping the premium down. Some of them do. They opted in this situation to buy a guaranteed survivorship contract that does generate cash values, so that if something happens to Stephen, that there would be value left in the contract if they wanted to get their money back out. So that was up to them. So next going on is to Pension Max. We've done seminars on Pension Max, and for those of you who didn't do it, I'm just going to here I'll go over very briefly what it is. I'm not going to do a detailed or an example on this because it'll take too long. But when people retire, they basically, and they have an option for a pension, they usually have some choices. One of them is that they can take life only, meaning that the pension would pay out X amount a month for as long as they live. It's usually the largest payout amount, largest monthly payout amount, and it stops whenever the retiree dies. Pretty straightforward. Then you can add someone with a spouse or a partner, and joint and 100% survivorship is usually one of the options. Now this is a much lower monthly amount, but it will continue, the same amount will continue as long as either person is alive. Then there's joint and 50%, joint and 75%. It's an amount someplace between these two, not as much as the life only, that's more than the joint and 100% survivorship. But if you take the joint and 50% survivorship, when one dies, and sometimes it's only when the retiree dies, most of them when either person dies, then the amount drops down by 50%. So it's still some money, but it's not as much when one person is died. Or you may possibly get a lump sum option. If you take a joint and survivorship option, you are actually buying a form of life insurance. You don't see it as life insurance, but it is. It's calculated based on mortality, and it has an effect on how much money you don't get or you do get. And so that is a form of hidden life insurance. So the question really becomes is, can you take life only, which is the largest monthly amount, and buy life insurance to cover that retiree, to provide a lump sum and therefore lifetime income for the spouse, for a monthly amount less than by doing it through the pension plan, which would be joint and 100% survivorship. So, and to do this, you do a combination of both term and permanent. So permanent does come into play, but you need some of each. So I'm going to answer this next question. Does it ever work if the client is at standard rate? And the answer to that is almost never. But I'll tell you when it doesn't work. If the retiree is a smoker, we've never had a smoker work or unhealthy. And probably if they're all the way down to standard on term, because that's the fourth layer down, it rarely ever works if they're standard. They pretty much have to be, the ones that we've done have been a preferred or preferred plus. So if they're standard, probably doesn't. Most government-sponsored plans, they don't work. And the reason for that is, in my opinion, is that they were designed by politicians, not actuaries. Most government-sponsored plans, there's not much of a drop if you take a joint and 100% survivorship. It's not actuarially sound, in my opinion, but so there's just very little difference. There's some difference between life only and joint and 100% survivorship, but not as much as the private plans. Also, if the pension has a guaranteed annual increases, it's very rare that Pension Max will work. And the other one is less than 90 days to make the decision. Why is that? Because that's approximately how long it takes to get the insurance in place and know that there's nothing's going to jump up and surprise us. if the person has to make the decision within the next next 30 days, you can do the math if you want to, but you can't really make the decision. You got to go with one of their options, because you can't take the life insurance option because you don't have the life insurance in place. And so if you're going to do a pension max, you need to do it further in advance. So I just answered that next question, by the way. I like you guys' way to think. You're thinking ahead of me. And then the hybrid life. This is a combination of benefits. What is hybrid life long-term care? It is a life insurance policy, a permanent life insurance policy that will also pay long-term care benefits out of the death benefit, out of the policy itself. It's a combination of that. Here's how you can become popular. How can, if you want to become popular, in my opinion, have this. Guarantee that someone will get a benefit. Guarantee that you have a positive rate of return on the premium you pay or the cost you pay. You can do that. Guarantee the premiums, guarantee the benefits, allow 1035 exchanges from old policies if they happen to have some, and, oh, by the way, provide everything on a tax-free income basis. So in my opinion, that's all the things that hybrid life can do. The problem with hybrid life, in my opinion, is that there's so many designs that there's not just one. So this is where you need to be, in my opinion, you need to be aware of some of the choices out there so that you can help us design the plan that works best for your client, because there's not just one hybrid life out there. There are some that have large long-term care benefits and a relatively small death benefit. There are some that have a guaranteed rate of return of the premium that has cash values, high cash values, guaranteed to get at least your money back if you don't ever use it, if you want to surrender it. You can have a high death benefit and less long-term care. You can stress the death benefit more. There are some that have multi-pay options, single pay, 10-pay, 5-pay, and they can be either reimbursement or indemnity plans. So all of those are out there. Not one has all of those options. So it's a choice of design of what it is you're looking for and what it is you want. Here's a real life case. Here's our Roger from Georgia. He's 65 years old, and he actually had 3 small insurance policies. All the policies were being paid by the dividends, so he was not adding premium to them. The dividends would pay the premiums due. And in total, he had $93,000 of death benefit, and he had $76,000 of cash value. But he was concerned about long-term care. So, and he liked the idea of life insurance. He didn't want to get rid of his life insurance, but he was also concerned about long-term care and didn't think he could afford it. So what did we do? We did 1035 of those 3 policies, got him a $175,000 death benefit, and I'll go back. He had a $93,000 death benefit, got him a $175,000 death benefit, guaranteed him $3,508 a month for 50 months, and this was an indemnity plan, meaning that if he qualified for long-term care, just like you do for long-term care policy, he would get the check for $3,508 and not have to prove how he spent it. And, oh, by the way, did I tell you this was all guaranteed and guaranteed no premium? So, do you want more? Do you want to know more about this? Well, the good news is that on November 11th, we're going to have a whole seminar to talk about hybrids, hybrid life, and hybrid annuities. And just for full disclosure, this advertisement has been paid for by Jerry Skapak himself. Second, I'm reading a question. Do you have a white paper on the hybrid? Give someone. Yes, we do. The question is, do we have a white paper on the hybrid policy? Yes, we do. It's actually in our tools, our advisors' tools on the website. It's an e-brochure. There's one e-brochure on the hybrid life and long-term care, and there's an e-brochure on the hybrid annuity and long-term care. So why permanent? Sort of wrapping it up. Well, it's there when you die. I mean, the term insurance may or may not be there. It is if you die at the right time. Permanent insurance, what I'm talking about, is there when you die because you are going to die. It's a great way, in my opinion, to pass on assets because you get by a lot of legal reasons, and you know exactly what it is. It's sort of a positive rate of return. Can be a guaranteed death benefit. It can be a guaranteed part of what's getting passed on. Cash when needed most. I don't think people understand as much as that until you have to live through one of those. It's a good to excellent rate of return. A combination of benefits are possible. It has tax advantages. But you know the real reason why people buy life insurance, why they buy permanent life insurance, it's because you love somebody. And I can't think of a better way to end. I got off more slides about what I've done, but I really don't care. You know, you buy permanent life insurance because you love somebody. I'm sorry, I really don't have time for questions. I've already used up more than my 50 minutes. I've got about 2 more minutes to go. I'll see if there's any, I will answer all these questions. See, a couple of 60. Says, I have a question here. Can a second to die policy be cost effective for couples near 60? They have a special needs child. Absolutely. My opinion, survivorship contracts are very cost efficient up until probably about age 75. So they're just near 60. And you know, if you talk to me about it or Mark about it, with special needs children and second to die policies, we would probably recommend the one that does generate cash value as well. It may be 2 or 3% premium higher than some, but still less than almost all of them because there's a no-load version. And should the special need child no longer need it for, I'm sorry, but the special need child dies and the parent's still alive and they want their cash back, it generates that. But if a child outlives them, it's a very, very effective and efficient way of generating assets. So, excuse me? Okay. See, I've got a question here. It says, if a policy is just a whole life, the death benefit does not increase by cash value, but universal life does. How does the cash value increase? Okay. With whole life, the cash value growth inside the contract, you do not get both. You get just a death benefit. The cash value grows. There may be dividends that you can use to purchase additional insurance. That's the way the death benefit would grow on a whole life. It is not because of cash value. As a matter of fact, at maturity, the cash value and the death benefit are the same. There is no pure life insurance left. The same thing is true on a universal life. It's an option A. If you want the cash value and the death benefit on a universal life, it's called an option B or option 2, where it's a death benefit plus the cash value. So you have that option with universal life. With whole life, you do not. The only option you have with whole life is what you do with the dividends, and you may be able to buy. You know, with universal life, you know, the ideal policy probably is you die with $1 left in the cash value because it's all pure life insurance. But so that sort of answers that one. Does pension max ever work if the client is only a standard rating? Why rating is usually necessary? So anyway, no. Usually, if they're only standard, that doesn't work. Also, as a way to migrate the loss of one Social Security retirement benefit after, another good choice of why you need permanent life insurance is that yes, when you have 2 people living and they both get Social Security, and then one person dies, obviously that person's Social Security goes away. And so saying life insurance is an excellent way of replacing that as well. So anyway, I think I got to go. Thank you all for listening. Next week or next month is long-term care, and after that I'm back with talking about small businesses and uses of a life insurance in a small business, not necessarily just all permanent, term and permanent. And then we have Jerry in November talking about the hybrids, and in December we talk about the various ways of doing 1035s. So thank you all. Have a good week. the rest of the week, and hope to see and hear from you during the next month. And I guess Joe will see you next month in the seminar. Thank you.